Stop watching silver futures. They're lying to you politely. Right now, physical silver in China is trading near $128 per ounce. U.S. Comex prices hovering near $111. That's a $16 to $18 split. And while you're watching screens, nearly 1 million ounces ripped out of Comex warehouses in a single day. This isn't a rally, it's a disconnect. If you're stacking, watching, or even ignoring silver, you're already involved. The physical market just repriced itself. Futures haven't caught up yet. And inventories are draining, while premiums are blowing out to levels we rarely see. If you're watching now, you're ahead of the headline crowd. This video teaches patterns, not predictions. I'm showing you what to watch and how to interpret it, not what to buy. Your job is to understand the structure before the structure breaks. Let's go. Quick thing, if this kind of pattern recognition matters to you, subscribe. You're joining the group that watches the right signals before they become headlines. And drop physical in the comments if you're tracking real metal, not just paper charts. Here's what actually happened. Shanghai premiums, the amount Chinese buyers pay above global spot, exploded to $15 to $20 over U.S. pricing. Normal premiums run $2 to $4. This is roughly 4 to 5 times stress pricing. At the same time, Comex registered inventories dropped hard. We're talking 500,000 to nearly 1 million ounces leaving warehouses in single-day moves. Why does this matter? Because price discovery is splitting in real time. Futures markets are global pricing mechanisms. They work when physical supply flows freely and arbitrage keeps regions aligned. But when physical metal gets tight, when buyers start paying premiums to lock certainty instead of waiting for delivery, the two markets decouple. Futures aren't wrong, they're just late. The real silver price already moved. You just didn't see it on your screen. This is the hidden layer most people miss. Premiums widen before futures spike. Drawdowns accelerate quietly. And by the time price reacts visibly, the metal that caused the move is already gone. What you're seeing now isn't theoretical. It's structural stress showing up as price divergence, inventory exits, and regional repricing. And it's happening this week. Let me name the first mechanism simply. Physical override. Here's how it works. Paper markets are fire hoses. They can deliver massive notional volume instantly. Contracts, claims, exposure. Physical markets are valves. They move real metal, and real metal has limits. Storage, transport, refining, delivery windows. When physical demand overwhelms paper supply, the valve chokes first. And when it chokes, real metal reprices, off-exchange, off-screen, in premiums and delays. Think about that. Chinese buyers right now are paying $60 to $80 more per ounce than U.S. pricing. Not because they're irrational, because they want certainty. They want allocated bars in hand, not paper claims that settle later. And they're willing to pay for that certainty because supply chains snap before prices spike. This pattern repeats across commodities. It happened in palladium in 2020. It happened in nickel in 2022. Silver just makes it visible because the market is small enough that stress shows fast. When this flips, it never flips gently. Here's the compounding layer. Physical override doesn't happen in isolation. It triggers a second mechanism I call the inventory cliff. Warehouses don't drain evenly. They drain slowly, then suddenly. Early drawdowns are quiet. A few 100,000 ounces here. A delivery there. Normal market function. But as inventory drops, the remaining metal becomes exponentially more valuable. Not because demand spiked, but because optionality collapsed. Imagine you're a market maker. You sold futures contracts assuming you could source physical if needed. But now, registered inventory, the metal actually available for delivery, is thin. Lease rates are spiking. Borrowing metal is getting expensive. Delivery requests are piling up. What do? You cover. You scramble. You pay premiums to avoid being the guy who can't deliver. And that scramble accelerates the drawdown. Circle this. The shortage doesn't start when shelves are empty. It starts when nobody wants to lend. When holding physical becomes more valuable than lending it out. When the marginal ounce, the last ounce available for delivery, becomes the most expensive ounce in the system. That's where we are now. Not predicting a squeeze, not telling you to panic buy, showing you the structure. Your job is to recognize the pattern, not predict the timing. Could this reverse? Absolutely. New supply could hit. Premiums could normalize. Futures could stay flat while physical stress eases regionally. Markets don't move in straight lines, and neither does supply. But here's what you need to sit with. The physical market has already moved. Shanghai pricing is $16 to $18 higher. Inventories are draining at 500K to 1 million ounces per day. Lease rates, what it costs to borrow silver, are spiking. And delivery month open interest is sitting uncomfortably high relative to registered metal. These are pressure gauges, and they're screaming. Let me connect these two mechanisms. Physical override creates the initial divergence. Inventory cliff accelerates it. Right now, we're watching both patterns compound in real time. Chinese buyers are paying premiums because they see what's draining, and what's draining is forcing premiums higher because the remaining inventory is shrinking. It's a feedback loop, and feedback loops don't resolve smoothly. Here's the hidden part most people miss. Futures contracts don't track physical stress until it forces them to. Futures are settled in cash most of the time. They're pricing mechanisms, not delivery mechanisms. But when delivery requests spike, when more contracts stand for delivery than registered inventory can cover, the paper market gets forced to reconcile with the physical market. That reconciliation looks like this. Premiums explode, borrowing costs spike, market makers scramble to source metal. Prices gap higher overnight because the marginal ounce, the last ounce available, reprices the entire market. Not saying that's guaranteed, saying that's the pattern. And the pattern repeats because supply chains are slow and markets are fast. You can't refine 1 million ounces overnight. You can't ship metal across continents instantly. But you can sell a futures contract in milliseconds. That mismatch creates leverage, and leverage cuts both ways. Imagine you're an industrial buyer. You need silver for manufacturing. You've been sourcing through futures contracts, settling cash, and buying physical when you need it. But now, lead times are extending. Premiums are blowing out. Your suppliers are using rationing language, limited availability, delivery delays, allocated quantities only. What do? You stop trusting paper. You lock physical. You pay premiums to guarantee supply. And when industrials start competing with investors for physical metal, the valve chokes harder. Circle this. Strong preference for immediate metal over paper claims is a tell. It signals trust erosion. And trust erosion accelerates inventory exits because everyone wants to be first in line. The last ounce is never priced rationally. It's priced desperately, not advice. Pattern recognition, here's what you need to sit with. Most people are asking the wrong question. They're asking, is silver going to rally? The real question is, what happens if the physical market keeps repricing and futures are forced to follow? Because right now, we're watching a split-screen market. Physical is pricing stress, futures are pricing sentiment, and the gap between them is widening while inventories drain. Think about the stakes for banks and market makers. If delivery requests exceed registered inventory, they're forced to source metal at any price. That's not a trade, that's a scramble. For hedgers and industrial buyers, if premiums stay elevated, input costs spike. If supply gets rationed, production stalls. For retail stackers, if physical reprice is permanently higher, the entry point moves. If premiums explode, affordability collapses. And for anyone watching from the sidelines, if this pattern resolves violently, the repricing happens in hours, not weeks. Can't know timing, only structure. Could premiums normalize tomorrow? Yes. Could new supply hit and ease pressure? Absolutely. Could futures stay flat while physical stress stays regional? It's possible. But here's the asymmetry. If stress eases, premiums compress and life goes on. If stress persists, the structural gap widens. And if stress accelerates into a delivery crisis, the physical market forces futures to catch up fast. Not predicting, watching. Let me lay out 3 paths. Path 1, premiums normalize. New supply hits. Industrial demand softens. Chinese buyers step back. Premiums compress back toward $2 to $4. Inventories stabilize. Futures and physical realign. Stress eases. Who benefits? Shorts, paper traders, anyone waiting for pullbacks. Who gets squeezed? Anyone who chased premiums high. Path 2, premiums persist. Supply stays tight. Demand stays strong. Premiums hold elevated but don't explode. We grind in this split-screen market for weeks or months. Physical stays expensive. Futures stay range-bound. Structural tension builds slowly. Who benefits? Physical holders, anyone who locked metal early. Who gets squeezed? Anyone waiting for confirmation that never arrives cleanly. Path 3. Premiums explode. Delivery requests spike. Registered inventory can't cover. Market makers scramble. Lease rates explode. Futures gap higher to reconcile with physical. The split becomes a crisis. Who benefits? Anyone holding allocated physical. Who gets squeezed? Anyone short? Anyone trusting paper claims? Anyone waiting? No guarantees, just scenarios. Your job is to watch the signals and understand the structure, not predict which path unfolds. So, here's what I'm tracking. Not telling you what to do, showing you what to watch. Shanghai silver premiums. Normal, $2 to $4 over spot. Stress, $15 to $20 or higher. Right now, $15 to $20. This tells you regional pricing is disconnecting. Physical buyers are paying for certainty. Daily Comex inventory changes. Normal, flat, small moves. Stress, 500K to 1 million ounce exits. Right now, 500K to 1 million ounce exits. This tells you metal is leaving the system. Watch for acceleration. Delivery month, open interest versus registered metal. Normal, comfortable cover. Stress, open interest exceeds or approaches registered inventory. Right now, uncomfortably tight. This tells you delivery risk is building. If more contracts stand than metal exists, scramble begins. Lease rates and borrowing costs. Normal, quiet, low. Stress, spiking, expensive. Right now, spiking. This tells you holding metal is more valuable than lending it. That's a supply signal. Retail and industrial lead times. Normal, days to weeks. Stress, delays, rationing language, allocation limits. Right now, extending, rationing appearing. This tells you the physical valve is choking downstream. Not just warehouses, distribution. Watch all 5. Together, they paint the picture. If premiums compress and inventories stabilize, stress is easing. If premiums hold and inventories keep draining, stress is structural. If premiums explode and lease rates spike hard, delivery crisis risk is real, not advice. Interpretation logic. Here's the risk cluster I use. Not commands, just lenses. Liquidity risk. Can you exit fast if you need to? Jurisdiction risk. Where is your metal held? Who controls access? Counterparty risk. Are you holding allocated metal or paper claims? Premium risk. Are you paying stress pricing that could compress? Timing risk. Can you wait out volatility without forced selling? Volatility risk. Can you stomach 10% to 20% swings? If you're a trader, respect volatility and use stops. If you're a long-term holder, accept pullbacks and focus on structure. If you're watching from the sidelines, understand the pattern before the pattern forces you to react. Your approach, not mine. Here's the truth. This isn't about buying silver. It's about knowing when markets stop pretending. Right now, the physical market is repricing while futures lag. Inventories are draining while premiums explode. And the gap between paper and physical is widening. Not because one is right and one is wrong, but because they're measuring different things. Futures measure sentiment. Physical measures supply. And when supply gets tight, sentiment catches up violently, not predicting that happens. Showing you the structure so you recognize it if it does. If you're watching these signals, if you're tracking premiums, inventories, lease rates, delivery stress, you're not reacting. You're anticipating. You're in the group that saw the pattern before the headline hit. And that positioning matters, because by the time this shows up on CNBC, the metal that caused the move is already gone. By the time premiums hit mainstream awareness, they've already blown out. By the time delivery stress becomes a story, the scramble has already started. Premiums move before headlines. Futures don't lead shortages. They explain them later. Your job is to watch the right signals and think structurally, not emotionally, not reactively. Structurally, could this reverse tomorrow? Absolutely. Could new supply flood in and normalize everything? Yes. Could futures stay flat while physical stress stays regional and contained? It's possible. But if it doesn't, If this pattern accelerates into a delivery crunch, the repricing happens fast. And the people who positioned early aren't lucky. They're informed. So here's my ask. Drop a comment. Have you seen premiums change locally? Are you noticing delays or rationing language from dealers? What signal tipped you off first? And if you're tracking this kind of pattern recognition, if you want to stay ahead of the headline crowd, subscribe. You're joining the group that watches pressure gauges, not price charts. I'll drop links below to Comex inventory data, Shanghai premium trackers, and lease rate sources, not telling you what to do with them, just arming you with the tools. Final thought. The physical market already moved. The question now is whether futures follow, and how fast. If you stay disciplined, watch the signals, and think structurally, you put yourself in the group that doesn't get shaken out when volatility spikes. And in markets like this, that's everything. See you in the next one.